Hey everybody, we're going to dig into Boston Omaha Corporation in just a second. Before we do, please click subscribe to my channel if you don't already, and take a look at the link you see on your screen for a message from my sponsor, The Motley Fool. It's the best way to support the work I do, and you'll get the top 10 stocks to buy right now. So, Boston Omaha, I'm a big shareholder. The stock is down 35% year to date. A lot of people are worried, and it's easy to see why. Not only is the stock down 35% year to date, it's at a time when the overall stock market is up, and there are no apparent major issues with the business that would really explain what's going on. So let's dig into the latest numbers first. Second quarter results were pretty strong. The stock popped briefly after these numbers were out, and then kind of gave back all the gains, and then some. Just hit a recent 52-week low. This is the lowest Boston Omaha has traded for since the middle of the COVID crash, when it was around $15 a share, and now it's about 17. Strong growth throughout its business. Billboard revenue was up 10% year over year. Broadband revenue was up almost 8%. Insurance was a real standout, up 40% year over year. Management said that the General Indemnity Group, that is their insurance subsidiary, was going to have some nice times ahead. And put all that together, combined with some investment income, and total revenue was up 16% year over year. The company finished the quarter with a little over $100 million of unrestricted cash and investments. Remember, this is a company whose market cap is under $550 million, so that's quite a bit of cash on the sidelines. About two-thirds of that is in treasury bills, smartly to get some interest income out of it, but it is readily available if the company sees opportunity. So that's some good news. Generated positive net income for the first half of 2023, $4.4 million of positive cash flow. And I wish they would stop selling shares in a down market, but especially without a real apparent reason to. When they have $100 million in cash, why do you need to sell another $9 million in stock? My biggest complaint is that they keep raising capital at these levels, even though they really don't need to, or at least I can't find any good reason why they need to. So why have shares done so poorly? Here are a few kind of potential reasons. Number one, a rising rate environment is generally bad for equities. It makes the cost of capital a lot higher. Um, Companies have a lot harder time, getting investors interested when they can get 5% yields on treasuries, things like that. Rising rates generally put pressure on stocks, so that's the big, macro reason. There are a lot of worries about commercial real estate, and Boston Omaha has some exposure to it. Boston Omaha Asset Management has two commercial real estate investment funds going through its recent acquisition of 24th Street Asset Management. And a lot of its business can be considered commercial real estate. The billboard business is a form of commercial real estate. Look at how the stock of, say, Outfront Media is doing. It's at a 52-week low. It's doing terrible because commercial real estate is there's a lot of worries about it right now. So Boston Omaha does have significant exposure to commercial real estate. Sky Harbor, its largest investment, is a commercial real estate play. And even broadband infrastructure is considered commercial real estate. That's kind of the whole premise of certain real estate investment trusts, is investing in in communications infrastructure like that. Boston Omaha Asset Management, just from what I gathered from attending the annual meeting this year, it sounds like they're having a tougher time raising money than they originally thought. Not a giant surprise in a tough market and with a recession widely expected. But that was a big positive reason for why people were buying the stock. And now it seems like they're having a tougher time raising capital. It's just a difficult stock to value is another reason. In tough times and uncertain times, if companies are too hard, investors tend not to go near them. In kind of booming times like we saw in 2021, people invested in stocks that didn't have great, easily understandable business models, and Boston Omaha is one of those. They don't release a lot of information publicly. They don't hold quarterly conference calls. It's a difficult business to really dig into on a ongoing basis, and I think the market might be punishing it for that. And finally, Sky Harbor, their biggest investment, I mentioned that's part of the commercial real estate thing, is down by roughly half since it peaked in March. That's a pretty big part of its valuation right there. So those are just a few potential reasons why it's down. It's not down for no reason. Let's be perfectly clear about that. But It is a pretty attractively valued stock right now. It's actually trading for below its book value for the first time in a long time, even though management said book value doesn't do a great job of telling the true value of the business. To the downside, they say it's worth more than its book value. So the short term could be challenging in several ways, but the long term thesis here is still pretty strong. I have not sold a single share. I'm thinking of buying some more in the next couple weeks if it stays at these levels. The only reason I wouldn't is just because it's already such a big position, but it's looking really attractive at these levels. I'd love to hear what you think, positive or negative. Please leave me any comments. I'll do my best to get to each one of them individually. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by the Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.